Welcome to the Deep Dive.
Great to be here.
Today, we're really diving into some quite powerful tools, specifically the ones traders use to try and spot potential market turning points.
We're talking about identifying price extremes, potential reversals. It's critical stuff.
Exactly. And we're not just talking about drawing lines on a chart, right? It's about trying to understand the psychology, the forces behind those price movements at really critical moments.
Yeah, the why behind the swings.
So our mission today really is to unpack two related but different approaches. We've got the stochastic oscillator, both the fast and the slow versions, very popular.
Very popular, yeah.
And then something a bit different, maybe more statistical, the Fisher transform.
Right, a different angle on the same problem.
These are, they're pretty essential tools if you're aiming for data-driven insights in your trading.
Absolutely. Understanding the data helps cut through the noise.
And actually, speaking of insights, if you find you're getting something valuable out of this discussion today, those moments where things just click about how markets work,
Yeah.
please do take just a second right now to, this deep dive. Maybe share it with someone else you think might benefit. And definitely subscribe so you don't miss out on our future explorations. We really appreciate the support.
Definitely helps get this information out there.
Okay, so momentum indicators, they're foundational.
Absolutely foundational.
Yeah.
They're key for finding those potential reversals, like we said, but also just for gauging the strength, the conviction behind a move.
Well, we've touched on this before, I think. We talked about the relative strength index, RSI.
We did.
Yeah.
RSI is a great example of a non-lagging oscillator. Its main job, really, is measuring the acceleration of price changes. How fast is price moving now compared to before?
Right. And we made that point that just because RSI hits, say, 70 or 80, the traditional overbought level, it doesn't automatically mean the price is going to reverse immediately, especially if you're in a really strong trend. It's telling you more about the strength of that move.
Exactly right. A strong trend can stay overbought on RSI for a long time. And this is where the stochastic oscillator really differentiates itself.
Okay, how so?
Well, while RSI is comparing recent price changes to past changes to gauge strength, the stochastic, its primary focus is different. It's fundamentally designed to pinpoint price extremes.
Price extremes.
Yeah, and identify those potential overbought or oversold regions. This difference, it comes directly from how it's calculated, its formula.
Okay, let's get into that. How does the stochastic formula give it that focus on extremes rather than just strength?
Well, the core idea goes back to George Lane, who developed it way back in the late 1950s.
Wow, that's been around a while.
It has.
Yeah.
And his principle was that momentum, basically the speed of price changes often shifts before the actual price direction reverses.
Okay, momentum leads price.
That's the concept. And the calculation reflects this. It takes a security's current closing price and compares it to its entire price range. That's the highest high and the lowest low over a specific period you choose.
So not just comparing close-to-close change, but where today's close sits within the total trading range of, say, the last few weeks.
Precisely. The default is often 14 periods, like 14 days on a daily chart, but you can adjust that. It's asking, where did the price finish today relative to the highest point and the lowest point reached recently?
Ah, I see. So it's positioning within that recent spectrum.
Exactly. By measuring where that close sits in the high-low spectrum, stochastic directly tackles the question. Is the price near the top of its recent trading boundaries or near the bottom? That's how it flags potential overbought and oversold conditions. It suggests the price might be stretched, pushed to an extreme within its recent context, and maybe due for a pause or a reversal.
That makes the distinction really clear. RSI is about the force of the change. Stochastic is about the location within the recent range. Very different perspectives.
Totally different focus, stemming from the formula.
And it shows this information with those two lines, right? The oscillating ones.
It does. You'll see two lines on the chart, both oscillating between 0 and 100. The main one is called %K, and the second one is %D. That was usually a smooth version acting as a signal line.
And those values, 0 to 100, that's where we look for the extremes.
That's right. Think about the calculation. Current close relative to the high-low range over, let's say, 14 bars. If the current close is very near the highest price hit during those 14 bars, climbs towards 100. That tells you the price is closing right near the peak of its recent activity, potential overbought condition.
Makes sense?
Conversely, if the close is down near the lowest low seen in that same 14-bar window, the %K line will naturally drop, heading towards 0.
Suggesting it's potentially oversold.
Precisely. It indicates the price is closing near the bottom edge of its recent trading range. So that comparison, that positioning within the high-low range, is absolutely central. It highlights whether the price is at an extreme point relative to its own recent history. It's a different flavor of momentum exhaustion than RSI's focus on the speed of the move.
Understanding that difference is crucial for knowing when and how to use each one effectively.
It really is. Now, when it comes to actually using this stochastic in trading, there are a few main ways people approach it. The most common starting point is those classic overbought and oversold levels.
Which are usually set at 80 for overbought and 20 for oversold.
That's the standard convention, yeah. When the decay line pushes up above 80, it's generally seen as a sign the market might be overbought, potentially due for a pullback or at least some consolidation.
And below 20 suggests oversold, maybe poised for a bounce.
Correct. Readings below 20 are interpreted as potentially oversold, hinting that a price rebound or an upward correction could be on the cards.
But, and this feels like a really important, but just hitting 80 or 20 doesn't mean you should immediately trade the other way.
Absolutely not. And this is probably the biggest trap for newcomers using oscillators. These levels signal potential extremes, but they give zero guarantees of an immediate reversal.
Right.
Think about a really strong, powerful uptrend. Price can just keep grinding higher, making new highs. In the stochastic, it can stay pegged above 80 in that overbought zone for days, even weeks.
So if you just blindly shorted because stochastic hit 80,
you could get run over by the trend. Trying to fight a strong trend based only on an overbought stochastic reading is a recipe for losses. The indicator might be screaming extreme, but the trend can persist much longer than you expect.
which just hammers home the point. You have to use these signals alongside other analysis, trend analysis, price action.
Couldn't agree more. Confirmation is everything.
Right.
A much smarter, more robust way to use stochastic is to align its signals with the prevailing trend.
Okay, how would that work? Give us an example.
Sure. Let's say you've looked at a chart, done your analysis, and you're confident the asset is in a clear uptrend. Higher highs, higher lows.
Yep, textbook uptrend.
Okay, in that scenario, you wouldn't really use an overbought stochastic reading above 80 as a signal to sell or short. Why fight the dominant trend?
Right, you'd be looking for opportunities to join the trend.
Exactly. You'd look for dips, pullbacks within that uptrend as potential buying opportunities. And that's where an oversold stochastic reading, dipping below 20 during one of those pullbacks, becomes really interesting.
So you use the oversold signal within the uptrend to time your long entry.
Precisely. Especially if you get confirmation from price action itself right around that time. Maybe you see a bullish candlestick pattern forming, like a hammer or a bullish engulfing bar, just as stochastic is turning up from the oversold zone. That combination, trend alignment, oversold reading, and bullish price confirmation, that's a much higher probability setup.
That's a completely different way of thinking about it. Using the indicator to time entries with the trend, not just betting against the price hitting an extreme level.
It's about trading probabilities, not certainties.
Confirmation, confirmation, confirmation.
Now, here's something interesting about stochastic, something that makes it quite useful in certain conditions where other indicators struggle.
Oh, what's that?
Think about indicators like MACD. It relies on moving averages converging and diverging.
Right, very trend focused.
Exactly. And in sideways, choppy, range-bound markets where there's no clear trend, MACD can often generate a lot of confusing back and forth signals, whipsaws.
Yeah, it gets messy when there's no direction.
But stochastic, because its calculation is based on where the price is within its recent range, can actually still be quite effective in those sideways markets. It can still highlight when the price is approaching the upper boundary of that established trading range, potentially signaling overbought within the range, or nearing the lower boundary, potentially oversold within the range. It can help identify potential turning points at the edges of the range, even when there's no overall directional trend.
That's a really valuable characteristic, so it can work in trends and ranges, potentially.
Potentially, yes. It's one of the few oscillators that people find useful in ranging environments. But, and it's a big but,
There's always a but.
trading sideways markets is inherently tricky. They're notorious for false breakouts, where the price pokes out of the range and then snaps right back in. So even using stochastic in a range requires extreme caution, clear identification of the range boundaries, and very solid risk management. You never rely on any single indicator alone, especially not in choppy conditions.
Wise words. Okay, what about divergences? We talked about those with the RSI before. Do they work with stochastic too?
They absolutely do. Divergence is a powerful concept across most momentum oscillators.
We covered the basics of divergence in a previous deep dive, so listeners can refer back to that. Does stochastic show divergences differently than RSI, perhaps?
It does tend to, mainly because the standard, or fast stochastic, is generally more sensitive and responsive than RSI.
Faster to react to price changes.
Yes, because it reacts more quickly to those short-term price fluctuations, divergences often appear more frequently on the stochastic oscillator.
Is that a good thing or a bad thing?
Well, it's both. The potential benefit is that you might get earlier signals of a possible reversal. The challenge is that because it's more sensitive, some of those divergences might be less significant, more like noise, and might not lead to a major price move. You might see it more often when the indicator hits an extreme zone like overbought, but then fails to make a new high along with price, a sort of failure swing within the extreme zone. This speed and frequency of signals is why some traders really like stochastic, especially for shorter-term setups, but it absolutely demands careful filtering and confirmation.
Okay, so the standard fast stochastic is quick, responsive, gives frequent signals, including divergences, but that comes with the trade-off of potentially more noise and false signals.
That sums it up well. Especially in volatile or choppy markets, that sensitivity can generate quite a bit of noise, making it harder to distinguish the truly significant signals from the background chatter.
And I'm guessing this is where the slow stochastic comes into play, to try and filter out some of that noise.
Precisely. The slow stochastic was developed specifically to address that noise issue inherent in the fast stochastic. It does this by adding a layer of smoothing.
Smoothing it out to make the signals clearer.
Exactly. The goal is to get more reliable signals by filtering out some of those very short-term, potentially insignificant price wiggle.
What's the end result for the trader looking at the chart?
The end result is a much smoother oscillator. You get fewer signals overall, fewer crossovers, fewer entries into overbought, oversold zones, but the signals that do appear are generally considered more dependable, more robust.
Less noise, higher quality signals potentially?
That's the idea. It filters out a lot of the market noise, making the slow stochastic arguably a more reliable tool for spotting those high probability extreme conditions in cleaner crossovers. It's particularly helpful in more volatile markets where the fast stochastic might just be thrashing around giving too many confusing signals.
So with slow stochastic, you're trading off some of that immediacy, that rapid responsiveness of the fast version,
for potentially increased signal quality and reliability. It gives you a smoother, perhaps more trustworthy picture of momentum extremes.
It's that classic speed versus reliability trade-off again.
Always a factor in indicator design.
Okay, let's switch gears a bit now. The Fisher transform. This sounds quite different. You mentioned it takes a more mathematical or statistical route to finding extremes.
It really does. Developed by John Ehlers, the Fisher transform shares the same goal as stochastic, helping to identify price extremes where reversals might occur. But its method is quite distinct. It's heavily rooted in statistical analysis.
Statistical analysis, how does that apply to price charts?
Well, the core function of the Fisher transform is to take raw price data and apply a mathematical transformation to it, aiming to convert it into something that resembles a Gaussian normal distribution.
A Gaussian normal distribution, like a standard bell curve.
Exactly, that symmetrical bell curve shape you see in statistics. The insight here is that raw asset prices, well, they don't always behave according to a perfect, neat statistical distribution. They can have fat tails, skewness.
Meaning extreme moves happen more often than a perfect bell curve would suggest.
Often, yes. So the Fisher transform applies this mathematical process to normalize the price data, essentially trying to reshape its distribution to fit that standard bell curve more closely.
Okay, but why? Why force price data into that shape? What's the benefit for identifying extremes?
By normalizing the data this way, the transformation has the effect of significantly amplifying or highlighting price movements that would be considered statistically rare or extreme if the data truly followed a perfect normal distribution.
So it makes the unusual moves stand out more.
Precisely. When the Fisher transform generates a very high or very low reading, it's signaling that the recent price action is statistically quite unusual or extreme compared to its own recent history, viewed through this normalizing lens. And the fascinating part is that these statistically rare extremes very often precede significant market reversals.
So it finds extremes based on statistical probability, not just where the price sits in a high-low range.
Exactly. And a key claimed benefit of its mathematical design is that it aims to minimize lag compared to many other oscillators. This allows it to potentially anticipate major turning points a bit earlier.
Minimize lag. That's always attractive. And how does it display this information? Is it a 0-100 scale like stochastic?
No, it typically oscillates around a zero line, moving into positive and negative territory.
Right.
While the exact theoretical bounds might be infinite, in practice, platforms often display it within certain visual limits. The key isn't necessarily fixed levels like 80 or 20, but rather looking for the extreme readings themselves.
So what constitutes an extreme reading on the Fisher transform?
Readings that move significantly away from the zero line are what matter. Commonly, traders look for values that push above a certain positive threshold, maybe around plus 0.8 or plus 1, or drop below a similar negative threshold. Different platforms might use slightly different scaling, but the principle is the same.
So reaching those high positive or low negative zones is the signal.
It strongly suggests that the price has reached a level that's statistically quite improbable relative to its recent behavior, according to the transformation. This often flags a potential exhaustion point and a pending reversal, especially if the Fisher line then crosses its own signal line, which is often included, while in one of these extreme zones.
Okay, so we have slow stochastic, using smoothing to find reliable range-based extremes, and Fisher transform, using statistics to find statistically rare extremes, potentially faster. If a trader is trying to choose, what are the main practical differences they should keep in mind?
Yeah, there are a couple of key practical distinctions. First, as we touched on, is that potential difference in lag and timeliness. The Fisher transform is designed specifically to reduce lag through its math.
Meaning it might give earlier signals.
Potentially, yes. It aims to react very quickly to conditions that represent statistical extremes. Slow stochastic, while smoothed for reliability, inherently introduces a little delay because of that smoothing process compared to the raw fast stochastic, and likely compared to the Fisher transform's aim for speed. So Fisher might flag a potential turn slightly earlier. Slow stochastic might be a bit later, but perhaps smoother in its signal.
Okay, speed versus smoothness again. What's the other main difference?
The other big one often comes down to, well, conceptual ease of use and familiarity. Slow stochastic works based on that intuitive idea. Where is the price closing within its recent high-low band? The 0-100 scale, the overbought oversold levels. It feels quite similar to other oscillators like RSI that many traders learn early on.
So it's maybe easier to grasp initially?
Generally, yes. It's considered pretty straightforward.
Yeah.
The Fisher transform, on the other hand, relies on that concept of transforming data into a Gaussian distribution. That might feel a bit more abstract or less intuitive if you're not used to thinking statistically. Understanding why normalizing data highlights extremes might take a bit more mental effort for some.
That makes perfect sense. One builds on a very visual, range-based idea. The other uses a less common statistical transformation. Different tools for different ways of thinking, perhaps?
Exactly. Both can be effective, but they approach the problem from different angles. One might resonate more with your style or how you see the market.
Right. So let's kind of wrap this part up. Both slow stochastic and the Fisher transform are really powerful instruments for traders who are specifically trying to identify those potential price extremes, the overbought, oversold conditions, and hopefully anticipate market reversals.
Absolutely. And understanding how each one works, the mechanics behind slow stochastic's range comparison and smoothing versus Fisher's statistical normalization, and understanding how to apply them, whether through levels or crossovers or divergences, and recognizing their key differences like timeliness and ease of interpretation. That understanding is crucial for choosing the right tool, or maybe even combining tools that fits your trading style and the specific market conditions you're facing.
And speaking of combining strengths and maybe even improving on these concepts, here at AccumulationPro, we've actually taken this area very seriously. It's led us to develop our own enhanced price extremes oscillator. It's become a really core part of our overall trading strategy. And we got there by using some pretty advanced techniques, actually things like machine learning, neural networks.
Yeah, applying AI to the problem.
To effectively blend the best of both worlds, you could say, trying to capture the stability and the reliability you get from something like a slow stochastic, but combine it with the kind of responsiveness and potential timeliness that an indicator like the Fisher transform offers.
The goal of that fusion is really to create an indicator that can pick up on those subtle signals of price exhaustion with hopefully greater precision and adaptability across different market types and volatility levels.
So if you, the listener, are looking to maybe elevate your trading analysis, or you're curious about these more cutting-edge algorithmic approaches to timing the market, We definitely invite you to learn more.
Where can they do that?
Just visit AccumulationPro.com. You can see how our algorithms are designed, how they aim to follow smart money principles, and how they integrate sophisticated tools like our own Price Extremes Oscillator. It's all there on the site.
And it's always worth reiterating, isn't it? Whether you're using these classic indicators we discussed today or advanced algorithms.
Disciplined risk management is absolutely essential. It's the foundation for any chance of long-term success. Non-negotiable, really.
Can't agree more. Now, just to leave you with something to think about, building on today's discussion, we talked about identifying extremes based on price's position in a range, like stochastic does, versus statistical rarity, like the Fisher transform.
Right. Two different ways to define extreme.
So consider this. In constantly changing market conditions, how might these two types of extreme signals interact? When might they confirm each other, and when might they diverge? And perhaps more fundamentally, how do you, as a trader, continually evaluate that trade-off? We kept coming back to the tension between an indicator sensitivity, getting those early warnings, but maybe more noise, versus its reliability, getting smoother, perhaps later, but more confirmed signals, especially when market volatility and trend strengths themselves are always in flux.
That's a deep question. Balancing that responsiveness versus reliability in a dynamic environment.
It's one of the core challenges in trading analysis, something definitely worth mulling over as you look at the markets.